Hi everybody, today I'm going to go over what index funds are, the advantages, disadvantages of investing in them, where to buy them, and how I'm going to retire as a millionaire with them. Stay tuned. John Bogle, the founder of Vanguard, and his team made it possible for average Americans to invest in low-cost index funds. Furthermore, Warren Buffett also says, by periodically investing in an index fund, the know-nothing investors can actually outperform most investment professionals. Usually mutual funds that were more expensive and that professionals claim that they can outperform the market. An index fund is a portfolio of stocks and or bonds that are created to mimic the composition and performance of a market index. Okay, what does that mean? In layman's term, an index fund is a basket of a bunch of different stocks and or bonds that are created to kind of copy an index. For example, there's the S&P 500, in which there are the top 500 US publicly traded companies that they track, instead of buying a couple of different stocks that you hope to beat the market with. You can think of these index funds as a basket of like different sized eggs. If you're vegan, you can probably think of it as different like types of tofu. You got soft tofu, firm, extra firm, organic. Anyway, why did they create something that has multiple stocks and or bonds? You can have more diversity in the types of stocks you own. For example, one of the really popular index funds, at least for Vanguard, is the Total Stock Market, or VTSAX. And if you're looking at another brokerage account or a taxable account, Fidelity has something similar to this too. The Total Stock Market Index Fund contains 3,640 stocks. So that means you essentially get a piece of all of those stocks. The purpose why they created the Total Stock Market Index Fund was so that people could have exposure to all different types of stocks, at least for the US companies. There are small, mid, and large cap companies that you're having exposure to. Low cap companies make anywhere from $300 million to $2 billion. Mid cap companies make from $2 to $10 billion, and large cap companies make over $10 billion. Another defining characteristic of index funds is that they have low expense fees. The expense fees are an amount of money that the brokerage will charge you for buying into the index fund, managing your account, and other like administrative management things. For example, if you're buying a mutual fund that are more expensive, tends to be 2 to 4% is the expense ratio. Versus an index funds have really low expense fees. If you look at Vanguard's VTSAX, it is 0.04%, so 0.004 versus 4%. So it's 100 times more expensive to buy into a mutual fund versus an index fund. And if you look at it just face value, it seems like not a big deal because 4% is so small versus like 50%. However, over time, if you look at the compound effects, you are losing out on thousands of dollars if you were to invest into a mutual fund versus an index fund. And you're wondering about the history of return. It really depends on the index fund, but VTSAX has done wonderfully for me. I started investing in early 2020 into my Roth IRA, and I've got a 40% return, which is wild. It typically doesn't perform this well. I think the last 1.5 years have been an anomaly. It's been a little weird, to say the least. I know this is not typical in that over the years, as I continue to invest long-term, not a short-term investor, except that one time I bought Dogecoin. That's a different video. My strategy for owning index funds is to hold them for long-term, so at least 5 years. One factor you want to check out before buying an index fund is to check the rate of return. If you go into the website of either Vanguard or Fidelity or any brokerage account that you're interested in, it shows you the percentages. For a 1-year return, the total stock market has done 44.33% return. Over 3 years has been 18.75%. Over 5 years, 17.9. Okay, you know how to read. And then 10 has been 14.70%. Overall, it's done really great considering inflation and the total return of the market. I want to go over briefly the different types of index funds. There are international index funds. So for Vanguard, it's VTIAX is a ticker symbol. This will give you an exposure to international stocks. The second one that you might be interested is called REITs. It's called Real Estate Investment Trust. So if you've never owned property and if you don't have enough money to do that right now, and or you don't want to deal with the management and people, well, guess what? You can actually own property by buying REITs. These are really cool because you can buy and own different types of property. REITs can include residential properties or commercial properties. Because it's property, there's a mandate or a law that says they have to pay their shareholders out in dividends. If you like dividend yielding stocks or index funds, this will be the one for you. Next is bonds also have index funds, which is really great for people who want to make sure that their portfolio is not too risky. Stocks are very risky, right? But more money. However, bonds can help balance out your portfolio, and there are different types of bonds. And the last index fund I want to bring up today is a target date fund. Basically, it's an index fund that you choose based on your retirement year. For example, if you want to retire in 2050, this index fund will actually have an allocation already for you. That just means you have a percentage of stocks and a percentage of bonds that they're already going to select for you. And the special thing about target date funds is that when you're younger, they're going to make it so that you have more stocks and fewer bonds. For example, like an 80% stocks and 20% bonds. Because you're still young, you can invest longer and go through the bear markets and the bull market. And then as you get older, closer to your retirement date, let's say it's 2045 and you're 5 years out of your retirement year, then what happens is they'll automatically and progressively switch your allocation to more bonds and fewer stocks. For example, maybe they'll do 80% bonds and 20% stocks, because as you're reaching closer to retirement, you don't want all your money to be gone. So they're going to be a lot more conservative and put bonds into your portfolio. Now I'm going to get into the advantages and disadvantages of index funds. An advantage of owning index funds is that you get a diversification of stocks and or bonds. You get so many different types of companies, hundreds if not thousands, because you have so many different types of stocks, which sometimes can be the total stock market. It's not like the economy is going to go to zero and that your investment is going to go to zero. Another advantage of index funds is its self-cleansing mechanism. What happens if one or a few companies go bankrupt or just don't do so hot is that, let's say in the total stock market of over 3,000 companies, is that those few companies will fall off and it won't really affect the total value or the current value of the index fund, right? Because there's so many other companies out there. Same thing for the S&P 500. Let's say stock 499 and 500 go bankrupt. They're not going to be in the S&P 500 anymore. The two new companies will come over and fulfill that top 500. Another advantage is that they have low cost expense fees. Another advantage that index funds are low effort investing. What I typically like to do is every month I invest in index funds, which is also called dollar cost averaging, in which you invest regularly or periodically, let's say bi-weekly, every month, every 2 months, because what happens is an index fund or a stock, their price can go up, so you'll buy it when it's high, but then another month it can be lower, so you'll buy when it's low, and it tends to average itself out. That way you're not timing the market and you're investing consistently. All right, let's go over disadvantages. A disadvantage of having an index fund is that people might feel compelled to sell when their index fund is not doing well. I mean, that goes across like all investments, but you know, think of like 2008, think of March 2020 when pretty much everything was falling. People feel like they want to sell, but that's the whole point of not checking your account often, right? And making sure that you have a long-term strategy. Another disadvantage of owning index funds is that you don't have control of what's in that fund, right? If you buy S&P 500, if you buy REITs, if you buy a target date fund, you don't get to tailor it yourself and be like, oh, for my index of my top 50 companies, I want to have Apple in it. I want to have Nvidia in it. You don't get to choose. So if you're more like a DIY investor, that might be a downside for you. Index funds are relatively new. So although it has overall been increasing, there's also dips in the market too. Don't think that these index funds are invincible, because they're not. I wanted to reference this thing called the lost decade. From the years 1999 to 2009 was considered the lost decade for many investors. According to pension funds, investors in the US tend to own a lot of US stock. I am guilty of that. That is very true. The lowest minimum was 2003, and then it shoots back up in 2008-ish, which looks like, if you only saw that window of time, it looks like, oh my goodness, it's only going up early 2000 and go later in 2009, you're back to 0%. So yes, while index funds are great, they're amazing, they do have a lot of growth over time. We want to come into the long term. You have to be strategic about what time you're going to take the money out of the market. How do you invest in index funds after this great list of all the disadvantages? There's a few accounts that you can open and buy index funds in. If you have an employer that offers a tax-deferred retirement account, such as a 403b, 457, or 401k, you might have index funds in your package. If you don't have that available to you, you can open a Roth IRA, or a traditional IRA, or brokerage / same thing as taxable account. And I wanted to go over briefly how index funds and compound interest can make me a millionaire. So I showed you my Roth IRA that I started with $18,000. If I were to invest 40 years and max out the Roth IRA with $6,000 a year, and let's say it's 7% return, let's go ahead and calculate it. Woo! Like the results are $1.4 million, so more than $1 million. So just to summarize index funds are a basket of stocks and or bonds that mimic an index. They typically are considered passive managed because you don't have somebody who's going to be actively managing your funds. It's highly diversified because you're getting exposure to hundreds and or thousands of companies. They have low expense ratios because they're not actively managed by a person who claims they can beat the market. It's best invested over long term. Some disadvantages of index funds is that you cannot choose your specific stocks and or bonds in them. Use that compound interest to your advantage and consistently invest. All right, folks, if you learned something today, please give this video a thumbs up or just like refresh your memory. You know, we are big brain folks over here. Also consider sharing this video with somebody who might benefit from this information. I will see you in the next video. Bye.